All right, let's dive deep into AU Small Finance Bank's Q2 results for fiscal year 25. We've got their investor presentation, the full financials with the auditor's notes, and even some questions you folks sent in to help guide our exploration.
It's a really interesting time for this deep dive, because AU's in the middle of this whole transition to becoming a full-fledged universal bank.
Right, and they're making this move while their presentation keeps mentioning a challenging operating environment. Think persistent inflation, tight liquidity, that long election cycle India just went through.
Oh, and don't forget the wild weather.
Right. The weather's been impacting businesses, especially those in rural and semi-urban areas, where AU has a strong presence.
It speaks volumes about their confidence that they're moving ahead with the universal bank application despite all that. They definitely see opportunity amidst all those challenges.
And they're not just talking. Their growth is remarkable. Total deposits crossed a major milestone, 100,000 crores. That's 1 trillion rupees.
Or about $121 billion USD, if you're keeping track globally.
Exactly. And it's not just the raw amount. It's the 12.7% increase quarter on quarter. And a big chunk of that, almost 11%, is from CASA deposits.
Now, for anyone who's not a banking whiz, CASA stands for Current Account Savings Account. And they're important because they're much cheaper for banks to maintain compared to, term deposits.
So that means more profitability.
Right. It's a sign of a healthy and expanding customer base. On the lending side, their loan portfolio also hit that trillion rupee mark with a solid 5.3% growth over the last quarter.
Okay, so attracting deposits, lending money, things seem to be moving, but the big question is, are they making money?
Let's talk profit. Profit after tax jumped a significant 42% year on year and a very healthy 14% compared to the previous quarter. 571 crore added to the bottom line.
Wow, that's a big jump in profit. What's driving that?
A few things stand out. One, they've diversified their revenue streams. There's been 25% growth in other income, which includes earnings from insurance, fees, and gains from their treasury operations. They're not just depending on interest income from loans.
Makes sense. Don't put all your eggs in one basket.
Exactly. Second factor is their tight control over operating expenses. Costs have stayed stable, so that revenue growth really boosts profitability.
Diversification and cost control, got it. How about the core lending business? How's their net interest margin, or NIM, looking?
While their NIM held steady at 6.1%, it's a good sign, especially with all the interest rate changes lately. It shows they're managing their assets and liabilities well, getting good returns on the money they lend out.
And their efficiency ratios are looking great, too. Cost-income ratio improved from 61% in Q1 to 57% in Q2.
That's a big improvement. Means they're getting more profit out of every rupee they spend. Efficient operations, that's key to their success.
It's not all perfect, though. The presentation does mention asset quality as a bit of a mixed bag. Some areas are doing well, but there are concerns, specifically those rising gross NPAs or not performing assets, up to 1.98% from 1.78% in the previous quarter.
Right, that's something to keep an eye on. The increase in NPAs is mostly from stress in their unsecured lending portfolio, particularly microfinance and credit cards.
They mentioned customer over-leveraging as a factor. Basically, some borrowers took on more debt than they can handle. Seems to be an industry-wide issue.
It is. However, AU's not ignoring it. They've tightened their lending criteria, reduced loan amounts, and made their collection efforts more robust.
Good to hear. Let's hope those actions are effective. There is some good news. The report says secured assets, like vehicle loans and mortgages, should do better in the second half of the year.
Yeah, historical trends and the expected economic uptick should help.
Makes sense. Let's switch gears to their digital strategy, which seems crucial for their future. Their AU 0101 platform has seen some impressive growth, 3.2 million registered users and 1.58 million active every month.
And those active users are really engaged, averaging 7 transactions per month. They're not just browsing, they're actually using it for banking.
That's encouraging. It shows people find the platform valuable and keep coming back.
Exactly. AU's using it to boost their wealth management offerings, too. Services like mutual funds, IPO applications, even a 3-in-1 broking service.
Building a whole financial ecosystem so customers can manage everything in one place.
And it seems to be working. They've attracted over 200,000 customers to their wealth management platform. Nearly 40,000 have active SIPs. That's a big win for a relatively new player in wealth management.
They're not content with just being a traditional lender, moving beyond into wealth management and, even more interestingly, International trade finance.
Their ADI, that's their international trade finance business, is a big statement. They've launched a whole suite of products for imports, exports, capital accounts, even retail remittances.
And they're using technology to streamline everything. Digital solutions like AU Digitrade and AU Remit. Are they biting off more than they can chew?
It's definitely a calculated risk, but if they can manage it well, it could really pay off and solidify them as a comprehensive financial solutions provider.
Now, let's get into the specifics of their loan portfolio. Total loan book is a huge euro 5,031 crores. What's the breakdown?
Mostly retail loans, good mix of secured and unsecured, not overly concentrated in any one area, which helps spread the risk.
Good to hear. What types of loans are the bulk of that portfolio?
Vehicle loans, categorized as wheels, are 30.6% of their total. Mortgage-backed loans, another 33.3%.
So over 60% is those two categories, both secured loans. Seems like a solid base. But even secured loans can be impacted by economic downturns, right?
Absolutely. And the report does mention some stress in their mortgage-backed loans, especially those classified as micromortgage loans or MBLs.
What's causing that?
Seems like the rough economic environment, along with heavy rains in some regions, has hit borrowers' ability to repay. Their gross NPAs and MBLs are 3.1%, a bit higher than the overall GNPA of 2.4% for their secured retail assets.
So even with collateral, there's still a risk of default. What's AU doing to manage this?
They still have confidence in their secured portfolio, believe that the final losses will be small because of that collateral. But they're keeping a close eye on these loans and working with borrowers who are facing difficulties.
That makes sense. What about the unsecured lending? That's where the bigger increase in NPAs was, right?
Yeah, microfinance, which is 7.3% of the portfolio, saw NPAs jump to 2.3%, shows the stress in that segment is really vulnerable to economic downturns.
And we talked about that customer over-leveraging, a concern in microfinance across the whole industry.
Exactly. AU has tightened their underwriting and reduced loan amounts to manage the risk, but they admit that credit costs in microfinance will likely stay high for a while.
Tough balancing act, growing the lending business while controlling risk. How about their credit card portfolio?
Still pretty small, only 3.1% of the total, but they are seeing challenges, gross NPAs at 3.2%.
What are they doing about that?
Being more cautious with issuing new cards, and they've strengthened their collections team to keep those delinquencies under control.
Seems like AU knows the risks of unsecured lending, and they're taking steps to address them. It's a delicate dance, balancing growth with careful risk management, especially in a volatile economy.
Exactly. Their success depends on how well they navigate these challenges and adapt as things change.
Now, before we move on, let's talk about ESG, which is becoming more and more important in finance. Environmental, social, and governance principles, how companies are managing their impact on the world, and how they operate.
AU seems to be taking it seriously. They've allocated 291 crore to green assets, backing sustainable projects like solar and electric vehicle charging stations.
That's a big investment. Shows they're backing up their talk on sustainability with real action.
They're also focused on social impact. Their skill development centers have trained over 23,000 young people and helped them find jobs. Plus, they've got programs to promote sports and women's entrepreneurship.
It's great to see a company not just focused on profits, but making a real difference in the world.
Their commitment to financial inclusion is obvious, too. They've got a big presence in rural areas with no banks and participate in government schemes like the PM Yan Dan Yohana, which aims to bring basic banking to everyone.
So not just focusing on cities, but bringing financial services to everyone.
Right. And they've organized over 16,300 financial literacy camps, teaching people how to manage their money well.
It's refreshing to see a bank balancing growth with sustainability and social responsibility. And it's getting noticed. They've received awards and improved their ESG ratings.
For sure. They see ESG as a core part of their business, not just a PR move.
Now let's look closer at their financials. Profitability ratios tell us how efficiently they're running things and generating returns.
Their return on assets, ROA, calculated on a monthly average of total assets, was 1.7% for the first half of FY25.
Slightly higher than their 1.6% ROA for the same time last year. So a slightly better return on their assets.
Return on equity, ROE, is even more impressive at 13.8%. Shows they're creating strong returns for shareholders.
That's a solid ROE. And their cost-to-income ratio.
58.7% for the first half of FY25, which is down from 63.6% for the same period last year.
So improved cost efficiency, that's good for their future.
Overall, their financial performance looks like a bank that's growing steadily, managing costs, and generating good returns. They're doing a lot of things right.
But there are always questions, especially for potential investors and analysts. Let's put on our thinking caps and explore some of those key questions.
Can they really make this transition to a universal bank? It's a big change. Requires a different scale, different regulations, more complex risk management.
Yeah, their growth and profitability are impressive, but can they keep that up in a more competitive and complex banking environment?
It's a valid concern. Now they're going up against established giants with a lot more experience in the universal banking game.
Sounds like a tough challenge.
Definitely not easy. But they've shown they're not afraid to take risks, and their ambition is admirable.
Another question is their ability to manage those asset quality issues, especially in unsecured lending. Rising NPAs in microfinance and credit cards are a concern. Can they control those risks while growing?
It's a balancing act. Too strict and their growth might suffer, but too loose and the bad loans pile up.
Investors will be watching those NPA trends very closely.
Absolutely. Asset quality is always a key factor in banking.
One last big question before we wrap up this part of our dive. Can they stay focused on their core customers, especially in semi-urban and rural areas, as they expand?
That's crucial. As they move into new areas and chase a wider customer base, will they lose sight of the segments that made them successful in the first place?
Classic dilemma for growing companies. Balancing expansion into new markets with keeping your stronghold on existing ones.
AU needs to make sure they don't alienate their loyal customer base in rural and semi-urban India. Those customers are the foundation of their success.
Right, they can't afford to lose them while chasing new business.
It's all about finding that sweet spot.
So we were just talking about AU's expansion, and if they can keep their focus on their core customers. That connects to something specific that stood out to me, their deposit strategy.
Yeah, it looks like they're intentionally shifting their deposit mix to create a really solid base, which is crucial for any expansion, especially that universal bank ambition.
Right, the presentation says Case A plus retail term deposits now make up a big 67% of their total deposits.
And get this, if you add in non-callable bulk deposits, that number jumps to 81%. Now, those non-callable deposits are basically large sums from institutions that can't be withdrawn before a set date.
Meaning they're less volatile than regular bulk deposits, a much more stable source of funds.
Exactly. Makes their funding more resilient, less prone to sudden shocks.
Smart move for any bank aiming for sustainable growth. Speaking of smart moves, let's revisit AU's digital platform, that AU0101. We touched on it earlier, but it deserves a closer look.
Yeah, they're riding that digital wave, and they seem to be riding it well. Still, 3.2 million registered users with 1.58 million active monthly.
That's a lot of users. And it's not just the numbers. The fact that they're averaging 7 transactions a month shows they're not just browsing, they're really using it for their banking.
Right. It's user-friendly, packed with features people actually need and use. AU gets it. Digital isn't a fad, it's the future of banking.
And they're using it to boost their wealth management side of things too, right?
Absolutely. They offer mutual funds, IPO applications, even a 3-in-1 broking service, all within that AU0101 platform.
One-stop shop for all your financial needs. Convenience and a smooth experience, that's the key.
Seems to be working. Over 200,000 customers on the wealth management platform already, and nearly 40,000 with active systematic investment plans, or SIPs. Not bad for a newcomer in wealth management.
Their total assets under management and wealth are 100 and 138 crore. Pretty good for a newbie.
Yeah.
But they're not stopping there. What's really interesting is how they're going beyond just the usual banking stuff, like that international trade finance business, ADI.
Oh yeah, they're not just dipping their toes in, they're diving right into those potentially lucrative new areas. They went live with a whole bunch of products covering imports, exports, capital accounts, even retail remittances.
And using tech to streamline everything. AU Digitrade and AU Remit, those digital solutions, it's bold. Sounds like they've already taken the hit for most of the setup costs for this.
Early signs are promising. Their monthly foreign exchange flow was US $75 million in September 2024. That's something. Shows there's real demand.
They're thinking long-term, laying the groundwork for future growth and diversification by stepping into these new areas.
It's calculated risk, but it could pay off big if they manage it well. That kind of forward thinking is what makes them stand out.
We can't forget about asset quality with all this talk about growth and expansion, especially for a bank growing this fast and entering new markets. We talked about their rising NPAs, but let's really break down their loan portfolio. Where are the risks and where are the opportunities?
For sure. The presentation breaks down that 105,031 crore loan portfolio. Like we said, mostly retail. Healthy mix of secured and unsecured loans.
So not too much reliance on any one area spreads the risk.
Exactly. Fits with their focus on serving individuals and small businesses.
Secured loans, the vehicle and mortgage loans, are a big chunk. Let's dig deeper there.
Sure. Vehicle loans under wheels are 30.6%. Mortgage-backed loans, including those micro-mortgage loans we mentioned, make up another 33.3%.
So over 60% just those two, both secured, solid base. But even secured loans can be hit by a bad economy, right?
Oh, definitely. Their overall gross NPA for secured retail assets is 2.4%, not too bad. But remember those micro-mortgage loans a bit higher at 3.1%.
Right, so even with collateral, there's still risk.
Always some risk in lending, but AU seems to have a handle on it. They believe losses on these secured loans will be small because of the collateral.
Okay, now let's move to the unsecured lending side. That's where the NPAs jump the most. What's happening there?
Microfinance, 7.3% of the total loans, saw their gross NPAs go up to 2.3%. Not surprising, this segment is very sensitive to how the economy is doing.
And we already talked about customer over-leveraging, a problem for microfinance across the board.
Right. Borrowers in this segment often don't have a lot of financial cushion. When the economy takes a hit, it's harder for them to repay.
How's AU dealing with these rising microfinance NPAs?
They've tightened their criteria for lending and lowered loan amounts to manage the risk.
Being careful about who gets loans and for how much.
Exactly. But they do say that credit costs in microfinance are probably going to stay high for now.
Tough environment for that kind of lending. Now, credit cards. Relatively small part of their business, but still facing some headwinds.
True, only 3.1% of the total, but gross NPAs are at 3.2%.
So even though it's small, it still needs attention.
They've made changes to lower risk, being more careful with issuing new cards and beefing up their collections efforts.
Making sure they're only giving cards to people who can handle it, and then being more proactive about collecting when payments are missed.
You got it. Managing asset quality is a constant balancing act for any bank.
Okay, let's shift to something else that's getting a lot of attention these days. ESG. Environmental, social, and governance.
It's about companies taking responsibility for their impact, not just chasing profits.
And AU seems to be embracing that idea. Their presentation highlights a bunch of ESG initiatives.
Like that 291 crore allocated to green assets, supporting things like solar power and EV charging stations.
Big investment. They're walking the walk on sustainability.
And their social impact work with the skill development centers. Trained over 23,000 young people and helped many find jobs. And those programs for sports and women entrepreneurs.
Really great to see they're committed to making a positive impact.
Their commitment to financial inclusion is clear, too. Big presence in those unbanked rural areas and participating in government schemes like PM Jan Dan Yodana.
So bringing banking services to everyone, not just the cities.
Right. They've even held over 16,300 financial literacy camps to help people manage their money better.
Refreshing to see a bank balance growth with sustainability and social responsibility. And it's not going unnoticed. They've gotten awards and better ESG ratings.
Absolutely. They're serious about making ESG a core part of their business.
Let's dive into some specifics on their financial performance, those profitability ratios. Tells us how well they're running things and generating returns.
Okay, let's start with return on assets, ROA. How much profit they generate from their assets. For the first half of FY25, it was 1.7%.
Up a bit from the 1.6% they had in the same period last year. A little more bang for their buck.
Their return on equity ROE is even better at 13.8%. Shows they're good at generating returns for their shareholders.
That's a healthy ROE. What about their cost-income ratio?
For the first half of FY25, it was 58.7%, down from 63.6% the previous year.
So better cost efficiency. That's a good sign.
It means they're always finding ways to do things better and more efficiently.
Overall, their numbers tell the story of a bank that's growing steadily, managing costs well, and generating solid returns.
They're doing a lot of things right.
But there are always questions, especially for potential investors. So let's think critically and explore some of those.
First one that comes to mind, can they really pull off this universal bank transition? It's a big jump. Different scale, new regulations, more complex risks to manage.
Their track record is good, but can they keep it up in a tougher, more complex environment?
It's a valid question. Now they're going up against the big guys who know this universal banking world inside and out.
Not going to be easy.
Not at all. But they've shown they're not afraid of a challenge, and their ambition is impressive.
Another one, can they handle those asset quality issues, especially with unsecured lending? Those rising NPAs and microfinance and credit cards are a concern. Can they manage those risks and keep growing at the same time?
It's a tough balance. Too strict, and they might not grow as fast. Too loose, and they risk a lot of bad loans.
Investors will be keeping a close eye on how those NPAs develop.
Definitely. Asset quality is a big deal in banking.
One more important question. As they grow and expand, can they stay connected to their core customers, especially those in semi-urban and rural India?
That's key. As they go after new markets and customers, will they forget the ones that got them here?
It's something a lot of growing companies struggle with. Keeping a hold on what you're good at while reaching for new opportunities.
AU has to make sure they don't lose those loyal customers in rural and semi-urban India. That's their base.
Right, they can't forget where they came from.
Finding that balance is key.
Another thing to think about is the potential impact of new regulations. The banking world is always changing, and new rules can really shake things up for a bank.
Yeah, like those discussions about changing the foreclosure rules for micro and small borrowers.
Those kinds of changes could hit their profits and force them to adjust how they lend.
Investors will want to know if AU is ready for those potential changes and if they can adapt quickly.
One last question. When a company gets this big and starts doing new things, can it hold on to that scrappy, innovative spirit?
As AU grows, will it become more bureaucratic and less willing to take risks?
Can they stay agile and responsive?
It's a common problem for successful companies. Holding on to that innovative culture as you grow is crucial.
So wrapping up this part of our look at AU Small Finance Bank, we see a lot of good things happening, but some potential bumps in the road too.
Their growth, profitability, and focus on digital are impressive, but those rising NPAs, the challenges of becoming a universal bank, and the possibility of new regulations mean we need to be cautious.
In the end, their success will depend on how well they carry out their plans, manage risk, and adapt to the ever-changing financial world.
As always, investors need to do their own research, look at their own goals and risk tolerance, and make smart decisions based on all the facts.
This deep dive gave you a good overview of AU Small Finance Bank, their strengths, their weaknesses, and what people are wondering about.
Keep learning, keep exploring, and as always, happy investing.
Okay, so we've gone through AU's impressive growth, the ambitious universal bank move, and some of the challenges like those rising NPAs. But let's zoom out a bit. What are their big priorities going forward in this exciting but also kind of uncertain environment?
Their investor presentation actually lays out a pretty clear roadmap. One of the top things is deepening their presence in their existing markets while also being smart about expanding into new areas. Not just chasing growth for the sake of it, they want to be strategic and make it last.
Makes sense. They've got that strong base in semi-urban and rural markets. Smart to build on that while carefully growing their reach.
Right, and they're really focused on all things digital. We talked about their AU0101 platform, how they're using it to create a smoother, more complete experience for customers. But they're not stopping there. They're putting a lot into technology to make operations more efficient, improve their risk management, and develop new products and services that customers actually need and want.
Sounds like they're all in on the digital revolution in banking.
Oh, absolutely. But it's not just about the tech itself. It's about using it to make things better for their customers, make their lives easier.
And of course, we can't forget their commitment to ESG, which is becoming more important for investors and customers every day.
For sure. And they're not just talking about it, they're doing it. Those investments in green assets, their focus on financial inclusion, and all their social impact initiatives show they're serious about building a sustainable and responsible business.
So strategic growth, digital focus, ESG commitment. What else is on their list?
They also want to build a really strong team and create a culture of innovation and collaboration. They get that their people are their biggest strength, so they're putting money into training, development, and making sure they've got a work environment that attracts and keeps the best talent.
Building a solid base for long-term success. But, like we said before, there are some challenges ahead.
Definitely. Investors are wondering if they can keep up this impressive growth and manage the risks that come with their expansion, especially in unsecured lending.
Yeah, it's tricky. Growth usually means more risk, so AU needs to be on top of that.
They also have to stay ahead of the game when it comes to regulatory changes. Banking is always changing. New regulations can really impact how a bank operates and how profitable it is.
So, got to be flexible and ready to adjust as things change.
Exactly. And as they get bigger and more complex, they need to be careful not to lose that entrepreneurial, can-do attitude. Easy for a large organization to get bogged down in bureaucracy.
It's a common trap for successful companies.
Yeah.
How do you keep that startup energy as you grow?
It's tough, but important. And it seems like AU's aware of this. They talk a lot about empowering their employees, encouraging new ideas, and always trying to improve.
So as we wrap up our deep dive into AU Small Finance Bank, I'm feeling cautiously optimistic. They've got a lot going for them. Great growth, a clear vision, and a real commitment to building a sustainable business.
But there are also some big hurdles to clear. Managing the risks that come with fast growth, navigating the ever-changing world of regulations, and keeping that entrepreneurial spirit alive as they grow.
Their success will come down to how well they execute their plans, adapt to change, and stick to their values.
This deep dive gave you a good look at AU Small Finance Bank, their strengths, weaknesses, and what investors are thinking about.
As always, do your own research, think about your own goals and how much risk you're comfortable with, and make your own decisions based on all the facts.
Keep learning, keep exploring, and happy investing, everyone.
And that's a wrap on our deep dive into AU Small Finance Bank. We hope you found it helpful and learned a thing or two. We'll see you next time on The Deep Dive.